Let's talk about how operating a multifamily property works. To start, let's cover how to determine what the value of a property is. Now, this is really the first thing that attracted me to multifamily. When investing in stocks, you have no control over performance. Hell, just one tweet from Elon Musk can cause Tesla's stock to slide. And with a single family home, you can run the home beautifully. You can care for your tenants perfectly and provide them with a great place to live. But when you go to sell the property, none of your hard work is really taken into account. Instead, your property's value is 100% determined on nearby comparable sales. So in the end, your neighbors determine how much your investment is worth. With multifamily, it's different. You're not just buying real estate, you're buying the underlying business. And the business is what derives the value of an apartment building. The price paid for a multifamily property focuses squarely on the net operating income of a property. As a quick reminder, that's income after factoring in vacancy, expenses, taxes, and insurance. And to determine the price of a multifamily property, all you do is take the NOI and divide it by the cap rate. The cap rate is the expected rate of return for an asset in a given market. And while you can't control a market's cap rate, currently cap rates for every market are low, with many between 5 and 6%. This means that for every dollar that NOI increases, if we assume a conservative 6% cap rate, the property's value will rise by over $16. And that's the real power behind investing in multifamily. Let's go over a quick example. Let's say we own a 100 unit property and raise rents by just $5 every month. This means an increase in NOI of $6,000 every year. When divided by a 6% cap rate, this small change results in a over $100,000 increase in value. And we can do this in reverse. One of our favorite things to do is look for properties that don't have updated technology. And we're talking simple technology here, like a toilet. If we could go into each of these 100 units and install low flow toilets, that could save us another $5 a month on our water bill. This will reduce our expenses $6,000 a year, and again, will boost our property's value by another $100,000. This is what we call forced appreciation. While most real estate waits for the market to generate appreciation, we're able to force it by introducing new lines of income as well as running the property more efficiently. Opportunities like replacing the toilets are central to the type of value add opportunities we look for at Altamane. Some other small opportunities that generate huge returns include fixing leaky pipes, installing new fiber optic internet and introducing it as a package for tenants to buy, updating all lighting to LED, or installing more efficient appliances. But the true number one value generator that we search for when finding properties is when current rent is far below what the rest of the market is charging. Oftentimes, rent at these properties is trailing by over $100 a month. By just bringing the rent back in line with nearby competing properties without even having to add any amenities or work on the property, this can bring an incredible day one value. Going back to our earlier example of a 100 unit complex, a change like this would impact a property's value by $2 million without any expense or effort. Now, to close out how multifamily works, let's quickly discuss how we can buy a property with this kind of opportunity. What type of loans are available to us for multifamily properties? Well, to start, all loans used are commercial, non recourse debt. This means that nobody is personally guaranteeing the loan, which tends to be attractive for most investors. This is also a huge reason why multifamily is perfect for a retirement account, as investors using their retirement funds can only take on non recourse loans within their account. And when we look at the two types of loans, we'll find that we have agency loans and bridge loans. With agency loans, these loans are backed by Fannie Mae or Freddie Mac, just as a loan would be if you were buying a single family home. These loans have somewhat rigid requirements, the prime one being that a property must be what's called stabilized. A stabilized property is one that is currently at least 93% occupied and has been for the last 3 months. These loans are great for properties of this nature with low interest rates and long terms as far as commercial properties go, generally up to 10 years. But oftentimes, we'll buy a property that is less than 93% occupied. It's struggling, leasing efforts have failed, and it needs someone new to come in and care for it. That's when we turn to bridge loans. Bridge loans are intended to create a bridge for you between when you buy a distressed asset and when you can qualify for an agency loan by stabilizing the property. Because of this, loan terms are shorter, often ranging between 3 and 5 years, and the interest rates are a bit higher, although in this market, we're finding that the difference in rates between agency and bridge debt is growing smaller and smaller. Of course, there are some more intricacies to these loans, but these are the general basics that you should know as you look to invest passively. And when you do invest, how long should you expect to be a partner in the property? Well, from the time the deal closes, most projects last between 5 and 6 years. This is how long you should expect to have your investment locked up in a property. That said, many projects employ a business case that plans to increase property value and refinance around the third year. This often allows for 50% or more of the original capital invested to be returned to an investor. In our case study video, I'll show how you can use this concept to your advantage, but just know that for every $100,000 invested in a project like this, you could expect to have the initial $100,000 locked up for 3 years, with the remaining $50,000 staying in the project for an additional 2 to 3. After the 5 or 6 year hold, there are two options that can be taken. The first is to sell the property. At this point, you'd receive your initial capital back as well as your share of any proceeds from the sale. If the property was bought for 5 million and was sold for 6 and you own 5% of all shares, you would receive $50,000 in proceeds from the sale. The second option at the end of the 5 years is to initiate a refinance. This is similar to the sale in that ideally the property's value will be greater after 5 years than when it was first purchased. This means that if the earlier property doesn't sell for but appraises for $6 million, the same situation would play out. You'd receive your remaining capital investment back, as well as any proceeds from the new, larger loan from the bank. But the nice thing about a refinance is that the partners still hold onto the asset. You've received your investment back as well as a healthy return. But now you still retain your overall share of the property going forward. If you own 5% of all the shares, you'll continue to receive 5% of all cash flow and 5% of any future sale or refinance. It's at this point you have what we call an infinite return. $0 of your initial capital is remaining in the property while you still continue to see income. Now that you know how multifamily works, our next step in your journey to becoming a Main Street investor is to learn what it's like being involved in a syndication and how all of this is structured.